Here is something your bank does not want you to think about too carefully. Right now, there is probably money sitting in your account, a number on a screen, maybe a few $100, maybe more. You believe it is yours. You believe it is real. You believe it is there. But here is the uncomfortable part. It is not there, not really, not physically, and in a very specific, very legal, very intentional sense, it was never fully there to begin with. What you have is not money. What you have is a promise. And the gap between that promise and the actual cash that exists to back it up, that gap is where one of the most quietly powerful tricks in all of modern finance lives. We are going to talk about that trick today. Not in an angry conspiracy theory way, in a precise, factual, slightly unsettling way. Because once you understand how this works, you will never look at your bank balance the same way again. Let us go back to a number, March 2020. The Federal Reserve announced it was cutting the reserve requirement for American banks to 0%. That means banks in the United States are technically not required to hold any portion of your deposits in reserve, none. The rule that once served as a thin thread connecting your money to something real was quietly snipped during a global pandemic, and almost nobody noticed. Why does that matter? To understand why that is extraordinary, you first have to understand what the reserve requirement was doing there in the first place. And to understand that, we have to go back much further, to a goldsmith in 17th century London and the accidental invention that changed everything. Imagine it is 1650. You're a merchant. You have gold. Gold is heavy, dangerous to carry, and thieves exist. So you walk it over to your local goldsmith, who has a vault, and you say, "Hold this for me." In return, the goldsmith gives you a paper receipt, a note that says, "The bearer of this document is owed this much gold." That receipt starts to circulate. People use it to pay for things. Why carry the actual gold when you can trade the paper? The paper becomes money. The gold just sits in the vault. And then the goldsmith notices something. Nobody ever comes to collect all the gold at once. On any given day, maybe 10% of depositors want their gold back. The other 90% just keep trading the paper. So the goldsmith starts writing extra receipts, receipts that are not backed by any gold at all. He lends them out, charges interest, and collects a return on gold that does not exist. This was fraud, technically, but it worked, and when it worked long enough, it stopped being called fraud. It got a new name: banking. That basic mechanic, holding a fraction of deposits and lending out the rest, is called fractional reserve banking, and it is the foundation of every major financial system on Earth today. Here's how it works in the modern version. You deposit $1,000 into your bank. The bank, under the old rules, was required to keep a small percentage of that on hand, say 10%. So it keeps $100 in reserve and lends out $900 to someone else. That someone else deposits the $900 into their bank. That bank keeps $90 in reserve and lends out $810. That gets deposited somewhere else, and on and on and on. 1,000 real dollars moving through the system becomes nearly $10,000 in total deposits. The money supply has expanded, not because anyone printed anything, not because any new wealth was created, simply because the same dollar was lent out, deposited, and lent out again. This is called the money multiplier, and in a textbook it sounds elegant. In practice, it's considerably stranger. Because here's what most people miss. Banks do not actually lend out your deposits in the way you might imagine, reaching into a pile of cash and handing it to a borrower. When a bank approves a loan, it does something far direct. It simply opens a new account and types in the amount. The money does not come from somewhere else. It is created in that moment as a new deposit backed by nothing but the borrower's promise to repay. The Bank of England confirmed this plainly in a 2014 research paper. Banks, it said, create money in the act of lending, not find it, not move it, create it. Let that settle for a moment. Every time someone takes out a mortgage, a car loan, a business credit line, the bank is not redistributing existing money. It is manufacturing new money and adding it to the total supply. The cash in circulation right now, the number on your screen, the balance in pension funds and savings accounts across the economy, a substantial portion of it was conjured into existence through loan approvals. In the United States, roughly 90 to 97% of the money supply exists only as digital bank deposits, not cash, not gold, not anything you could hold, just entries in databases, owed back and forth between institutions, resting on a collective agreement that the whole thing is real. Now here's where it gets interesting. Banks do not create this money for free. There's a cost. The interest they pay you on deposits, the cost of capital, regulatory requirements, and the loans they make are not random. They're supposed to be backed by collateral and creditworthiness. The idea is that the new money is attached to something productive, a house being built, a business expanding, a car being manufactured. The debt and the asset grow together, and the economy expands. In theory, this is genuinely elegant. Credit creation allows economies to grow faster than their physical resources alone would permit. The United States built its interstate highway system, funded its universities, launched its technology sector, all on the back of credit that was, in a real sense, created from thin air. But there's a tension buried inside that elegance, and it has a name. When the loans are repaid, the money disappears. It is destroyed the same way it was created, through an accounting entry. The money supply contracts. If loans are repaid faster than new ones are issued, the money supply shrinks. Businesses struggle to pay their debts. Workers get laid off. Spending drops, which causes more loans to go bad, which causes banks to issue fewer new loans, which shrinks the money supply further. This is not a theoretical concern. It is a description of 1929. It is a description of 2008. It is a self-reinforcing cycle that sits at the core of every major economic contraction in the modern era, and it is structurally built into a system where private institutions are responsible for the expansion and contraction of the money supply. Which brings us back to 2020. When the Federal Reserve cut reserve requirements to zero, it was not introducing a new risk. It was acknowledging an existing reality. Banks had already been operating with effectively minimal reserves for years, relying instead on capital requirements and central bank backstops. The reserve requirement, that thin rule that once suggested banks should keep something in the vault, had become largely ceremonial. What replaced it? The implicit guarantee that the central bank would step in, that if things went really wrong, if people started demanding their money back at scale, if the whole multiplication went into reverse, the Federal Reserve would provide liquidity, would create real money to cover the promises. Which it has done, repeatedly, aggressively, in 2008, in 2020, in various crises in between. The backstop is real, and it has mostly worked. The system has not collapsed. Your deposits have been safe. But here's the quiet irony at the center of all of this. The mechanism that keeps the system stable is itself a form of the same trick. When things go wrong and the central bank steps in, it doesn't pull money from a reserve, it creates it. The Federal Reserve's balance sheet went from under $1 trillion before 2008 to nearly $9 trillion by 2022. That money did not exist before. It was created to stabilize a system that itself runs on created money. Money backed by money that was backed by the promise of more money. The stability of the modern financial system rests on a chain of institutional promises, held together by the belief that the institutions at the top of that chain, the central banks, the governments behind them, will always be credible, always be trusted, always be able to make good on what they say. And for the most part, they have been. But credibility is not a physical asset. It cannot be audited. It cannot be locked in a vault. It exists only as long as enough people believe it does. The goldsmiths' receipts were only worth anything because people trusted the goldsmith. The moment that trust broke, the whole structure came apart. And every financial crisis in the last 3 centuries has been at its core a crisis of that exact same trust, just at a larger scale, with more zeros and considerably more sophisticated language to describe what is happening. So the next time you check your bank balance, consider